Did you know that 90% of active investors actually underperform the market? What if I told you there's a way to beat most investors with almost no effort? In this video, we'll break down the best ETFs for European investors in 2025, focusing on strategy that requires minimal effort yet delivers strong long-term results. Over the last 5 years since I started sharing my knowledge with the world publicly, I have built a portfolio exceeding 100,000 euros, consulted over 500 clients, and helped people invest more than 15 million. I'm here to share what actually works. If you want no nonsense actionable strategies to transform your financial future, you're in the right place. Now, investing can feel overwhelming, especially for beginners. The biggest challenge is deciding where to put your money without getting lost in thousands of options. This is where ETFs come in. Exchange traded funds offer an easy, low cost, and diversified way to grow your wealth without the complexity of picking individual stocks. More importantly, passive investing through ETFs consistently outperforms most actively managed strategies over the long run. So if you're planning to invest at least for 10 years, I think this is one of the best choice. Now, why does passive investing work so well? The key is avoiding emotional decision making and high fees. Most investors make the mistake of constantly buying and selling, trying to time the market. Research shows that this approach often leads to worse results than simply holding a diversified ETF for decades. Now, by sticking to passive ETFs, you take advantage of compounding, minimize trading costs, and remove the stress of constant market analysis. Now, let's talk about the best ETFs for 2025. We will focus on three core index-based ETFs that provide a solid foundation for any investor: the Nasdaq 100, S&P 500, and Global All World ETF. These options cover growth, stability, and diversification, making them ideal for European investors looking for long-term success. Now, we will cover the best options as well as cheapest alternatives which are available for significantly smaller sums if you want to invest, let's say, 100 euros, for example. First, Nasdaq 100 ETF, represented either by this or this. It's a great choice for those who believe in technology-driven growth. This ETF includes companies like Apple, Microsoft, and Nvidia, which have consistently outperformed traditional industries. Now, while the Nasdaq 100 tends to be more volatile, its historical performance shows strong long-term returns, making it a good option for investors willing to tolerate short-term fluctuations in exchange for higher potential gains. Let's investigate through analytical tools. First of all, I'm heading to justetf.com. This is a main analytical tool for any ETF analysis. Now, the way I look at it, I simply enter Nasdaq 100 and look where majority of the money is already going. All right, we have a total of 15 ETFs, and you can see that the first one, let's add it into the table, it got majority of investors in one piece. So the first place is 13 billion altogether, and the second place is like less than 7 billion. Now, it is accumulating full replication, and we can find it by simply copying the ISIN code. Now, if I copy this ISIN code into a broker, I'll get three different options: CNDX, SXRV, or CNX1. Now, SXRV is in euros, others are in dollars and pounds. You can see that one unit costs 1,161 in euros. Obviously, not everyone can invest if they invest 100 euros. You have to be able to invest significant sums to literally have anything similar like this. At the same time, ANAF is same strategy, same sort of Nasdaq 100 focus, and it costs 17 euros. Now you can choose to invest in one or another. It still focuses on the same index. What I normally suggest to do is always open the fact sheet and read a little bit about it. Now, first of all, okay, where am I investing? Fund overview. Key benefits of investing here. What's the goal here? Expense ratio is something important. I'll talk about that in other videos, but anything up till 0.5 is acceptable in my idea. Anything above that, you have to have a very specific reason. Now, BlackRock always have these super nice what would happen if I would invested $10,000 since inception. And you can see that if you invested 10,000 in, what is it, 210, at the moment you would have somewhere above 120,000. That's not a bad return. And you can see that returns share class is here. 2015, 9%, 6%, 32%, minus 0.44, 38, 48, 26, minus 32, 54, 24. The idea here is to understand where I'm investing. Since inception, average return 18%. I don't think I would expect exactly the same for the next 20 years, but I would expect it to be somewhere above 12%. Now, when you invest in Nasdaq 100, you have to know that majority of your investors are in IT sector, and you can see the top 10 businesses, and you should know that financials are not here. Like, we don't exist in Nasdaq 100. So Nasdaq initially picks the top 100 businesses in Nasdaq stock exchange based on market caps. To understand it simply, the bigger the company in exchange, so the bigger the market cap, the more place it will take in actual index fund. And if we want to check the same ANAV, now it doesn't have a marketing distribution, right? So do analyze that piece, but you can see initially how long it's been around. It hasn't been created for that long, but the returns here, if you add the graph next to the main one, you'll see that it's quite similar. And you can see that it focused on Nasdaq 100, it's full replication, it's accumulating, and the total expense ratio is even smaller than that one. And I believe as the fund size grows, it will have all the required additional documents once the history is there. And you can see as well, Apple, Nvidia, Microsoft, top 10 holdings, how much they have, how much is in technology, and so on and so on. Now, any of these choices are acceptable, but let's move to a couple more others, because this is only the first strategy. Now, next we have S&P 500 ETF, represented by EVA SX08 or SPYL. It's one of the most reliable investments in the world, covering the 500 largest US companies. This ETF will provide a balance of growth and stability. It includes companies across various industries, reducing risk while still capturing the market gain. Now, for investors who want a proven low-risk way to grow their wealth, the S&P 500 is a solid choice. Now, let's investigate a little bit more about these as well. Now, straight away, you can see that the first one is like 600 euros, the second one is like 14 euros. Now, if I open just ETF, you'll see that results is literally almost the same. Now, SPYL does not exist that long, but it's literally both of them in one file. You can see that every now and then I get that orange piece marked, and it's like the same fund with the exactly same results. Now, one is significantly smaller than the other one. Obviously, one is a little bit cheaper than the other one, but 0.07 and 0.03, both of them are super cheap. Focus on S&P 500. We do have long only focus, and we do have accumulating funds. Now, this helps us because we don't have to deal with taxes until we actually sell this. Holdings are almost the same, 500, 500, 37, 37, and you can see Apple, Nvidia, Microsoft, Amazon, so on and so on and so on. United States, yeah, everything, some cash while it's dragging within the fund. And obviously, we are focusing still on technology quite heavily. You can easily open the fact sheets and ask for some additional information in these by simply heading here, and you can see the fact sheet of here and kids and prospectus annual reports and everything else from this one. This is one of my favorite ones, and I actually have it in my own portfolio too, which you can track. At the moment, 1,000 people is actually tracking this. And I use SPYL as example whenever I invest small amounts of money. So it's here in my account too, but I have some other examples in my managed portfolios where I actively manage certain investments. If you want to check them out, they're all in the description. Now, finally, we have to head to the All World ETF, represented by the one and only VWCE. That's the ticker. Offers the most diversified approach. This ETF covers major global markets, including the US, Europe, and emerging economies. If you want a single ETF that includes exposure to all major economies, VWCE is the best option. Provides automatic diversification, and it's ideal for investors who prefer the handoff strategy altogether. Now, let's investigate a little bit more detailed, and I can show you one of the examples where I invest small sums by simply buying the same fund again and again and again, which is VWCE. This is simply showing the results of me adding 100 euros again and again and again into the same fund without doing anything else. It's quite straightforward and it doesn't require any time. Now, VWC is Vanguard All World FTSE All World ETF. You can see 0.22 active like the management fee or total expense ratio, but here you have quite a significant piece. Average return a bit over 11%. I would more expect 9, I would say, in the future. But top 10 holdings are quite familiar because they're just biggest businesses in the world. But the fund has 3,655 businesses within it, and it's from around 50 different countries. You can obviously see that technology is still in number one, but United States, Japan, United Kingdom, China, Canada, France, Switzerland, so on and so on and so on. Now, America is massive in investing world. It's a super economy altogether, in a sense that none of the funds which are focused on all world will ignore America. It will have a hefty sort of side, and you can see that it's 65% almost. But the idea here is that if America, for whatever reason, starts to shrink and money starts moving to different countries, this fund will do it on its own, will allocate that money to the different country without you doing anything. So you're initially betting that the businesses in the world will still make more and more money in the future. Now, for me, that's the best business case altogether. All right, so why are these three ETFs the best choices for 2025? The answer comes down to cost, accessibility, and strategy. All three have low expense ratios, meaning you keep more of your returns instead of paying high management fees. There's also cheap alternatives if it's too expensive to invest in these. These are also widely available on major European investment platforms, making them easy to buy and hold. And most importantly, these ETFs align with simple, effective strategy that beats majority of active investors. So buy, hold, and let compounding do the work. Once you've chosen your ETF, the next question is where to invest. There are several great platforms available for European investors. Freedom24 offers access to these ETFs along with additional investment opportunities. This is one I use because it gives me a free option to share my portfolio with the public. The key takeaway is that you don't need to overcomplicate investing. The best strategy is to start, stay consistent, and let your investments grow over time. If you're ready to begin, check the links in the description and start. At the same time, if you want to see the portfolios without actually pressing any links, here's the video where I overview my practical experiment, a total of like 2.5 years of investing small sums and a total sum of like 17,000 plus. Check that out here, and I'll see you in the next video.